this is where we might be going. We're just going to go quickly. So the interesting thing about this is the direction of the estimates. So right now, well, for the last year, the estimates have been coming down. But right now, they're coming down precipitously because of the oil trade. Oil is an enormous part of the global economy, as we all know. And because of that, they're saying GDP is going to go down. The effect of the price of oil on the companies that produce oil and the companies that drill is instantaneous. The effect for us takes some time for us to get used to it. So I think long-term, low prices of oil is good for us. I think short-term, you're going to see some shocks. And if you see those short-term shocks become big enough in a Venezuela, in a Russia, they can have spillover effects in bond defaults or in currency problems. Remember long-term capital management? That was a Russian currency problem. We could have that problem again. The ruble is right now in free fall. So this is entirely possible. So it's just something to be aware of. Do we have a lot of Russian investment? No, but everything is integrated. So these rates, these growth estimates have been coming down steadily, and now they're coming down quickly. And we talked about this, and this is why I've highlighted a couple of these items. So Journal's Economic Forecasting Survey said, this is the biggest threat, is a single negative global event. Could be Russians saying we can't pay our debt. Venezuela could say the same thing. Any of the emerging markets currencies could do that. Any of the emerging markets could do that. As the dollar gets really, really strong and they're pegged to the dollar to fight inflation, they can't keep that peg. So they lose the peg, they default on their bonds. Asian contagion didn't happen that long ago. Same thing can happen. Okay, so lots of potential challenges that are out there. And then at the end, we have a few positive possibilities. Deflation derailing an economic recovery. So stagnation has begun. Does it become something like Japan in the last 25 years? We won't know for probably 20 years. Maybe they come out of it, and maybe Draghi will be committed enough to QE that he'll push them out of it the way we were pushed out of it. But if he does, how will we respond? Because our corporations will suffer. If the dollar gets stronger and stronger and they drive, I think it was a Goldman Sachs research report said, does anyone know what the currency trade is right now? A dollar is how many euros? 112. So Goldman Sachs said it was going to be 90 cents. So that's a 20-something% decline this year. So dollar's going to get stronger, okay? Scary. What does that do for the rest of Europe? How will we respond? How will it affect our corporations and our we didn't even touch on this. We touched on it last 6 months ago. We have margins, corporate margins, their profit margins, all-time high. Never been this high, ever. How will it affect corporate profit margins? Negatively. It's the only way it can affect them is negatively. Okay. So growth with a chance of policy mistakes and commodity price slumps hurting the emerging markets. So emerging markets, that's the source of future growth. We've been saying it, everyone's been saying it. If oil and the stuff that comes out of the ground in the emerging markets goes down in value and they don't have that to sell, it's much more difficult for them to grow. How do they stimulate their own economies if they don't have the resources to do so? The way they should do it is with trade. That's how that works, is you guys do something, then we do something, and we do the best of those things. But we've had two different experiences in the recent memory of those economies and countries having problems. So this is a boost, short-term pain, long-term gain. Don't believe for a second it stays here, though. Again, commodity is a cycle. Production's going to come out, demand's going to go up, it's already happening, and eventually we're going to see that right itself. It's always a search for the right price, and that's a moving target. The right price in a commodity is always a moving target. Russian intervention. So the issue here is we don't know how far he goes. I mean, I just already touched on a couple of things. The ship, when U.S. envoys went down to Cuba, the spy network, one, we don't know if there's others. There's just, this is beginning. So we're going to look real quick at this. So if Chinese domestic demand goes down by 2%, it affects, this is just one country's domestic purchasing goes down by 2%. it affects U.S. in 2015 and 2016. Wait, this one, 25 basis. So if we're growing at 2.5%, we're now growing at 2.25%. So if Chinese domestic demand, it has a very outsized effect on the global economy. This is just people in China buying healthcare and maybe jeans and shoes and buying gas. So if their economy slows, it has a big effect on the rest of the economy because they are becoming consumers. Also, though, and they've got the resources to do this, if they stimulate, they've already reduced rates a little bit. And remember, at 8% growth, they actually slowed it down intentionally. The question is, did they slow it down a little bit too far? And so they've started reducing rates to allow a little bit of stimulus to happen, to allow some business to occur. Okay, so they may be stimulating enough. We'll see how this comes. It's just something to watch. Chinese growth. So the Fed rate hike is coming. We don't know when it's coming. It'll come end of the year, maybe next year. When I was in Chicago, and there's Eugene Fama, who he took a stage and he was talking, and he said, the illusion here is that the Fed will be able to raise rates. Interesting question. So people peppered him with questions on that. What do you mean, Eugene? Why couldn't the Fed do it? There's so much global demand for US Treasuries that even if he says, okay, Fed fund rates going up, the demand could push it back down, which means we won't be able to raise rates. We've never had that experience before. We don't know how that plays out. So this is the continuing challenge that was brought about by how do we, a $4.5 trillion balance sheet, interest rates down to zero. Maybe we just grow our ways out of it. Maybe that happens. Maybe we have enough momentum that the QE in Europe isn't going to hurt us. Maybe none of these other issues are going to come up and hurt us. We're not investing on that scenario. We're investing with the possibility that these things happen. Okay, so here's some positive. The consumer is just spending. Are you spending more? Well, the consumer is. I don't know who's sitting here, but the consumer is spending more. It's interesting. You talk to a group, maybe, I wonder, sociological study, I wonder if I said, are you spending less? It's too late now for this, right? But I wonder if there's a problem here in Berkeley to raise your hand and say, yeah, I'm spending more. Like, do you feel like you'd be judged by your neighbors? Only one head shake, no.
Absolutely not.
Okay, good. So has anyone bought a new car in the last 5 years? A new machine for working? Yeah, see, there's hands going up. What do you mean you're not spending more? Did anyone look at two cars and say, God, I really like this more expensive one, but this one's more practical, and you went with the more expensive one? Uh-huh.
I went for the cheap.
You went with the cheaper one? Okay. It's interesting. So we have some consumers here. Not everyone's a consumer. Okay. So the consensus, and this is interesting to me. So 2013, we started the market. We were maybe a little bit undervalued. 2013 happened. At the end of 2013, we were overvalued in the S&P 500. And we have been overvalued ever since. 2014, we got a little bit more overvalued. And we'll look at this in a second. And in 2015, they're saying, we're going to get a 10%, this is the Wall Street strategist, we expect a 10% return on the S&P 500. But we actually expect a 7.5% increase in earnings. So what they're saying is, by the end of this year, we'll even be more overvalued than we are now. We're expecting the market to keep going up faster than earnings going up. When we talked about the second law, what was the second law of investing? What do stock prices follow eventually? Earnings. So if stock prices keep going up more than earnings, and keep going up more than earnings, and keep going up more than earnings, what happens? Correction. We correct back down to where earnings are, but is the stock market calibrated to stop where earnings are? No. It never goes, oh, here's earnings. It doesn't do that. It goes down to here. Oh, wait a minute, we missed earnings, and it comes back, right? Because once it's here, it's like worried, what if earnings aren't real? Oh, we're going to go down here until we know that earnings are real. So in the last 200 years, I don't know who is it Schiller? Someone has a line. It's a 6.5%, 7% earnings increase line. And the line it's almost perfect from beginning to end. It's about a 6.5%, earnings go up at about 6%, 7%. There's a little bit of financial leverage that a company can employ to make it 10%. So we can actually get higher earnings than that. But to have stock prices go more than 10, once you see that many years in a row, you know there's going to be some kind of correction. At the same time, here we go. Is it the next one? No. So here, this is the 5-year average, the lower line, and then the dotted line's 5-year. This is the 10-year average. We're here. This is 2006. Is that right? Yeah, 2006. This is the bottom in 2008 and 9 of PE ratio. So we're here. We were up in 1999, 2000. We were up in this range. We were up here, 22, 23. So there's times in the past when it's been much higher than this. However, there are lots of metrics of valuation. Warren Buffett's favorite metric of valuation is the stock market valuation, which he uses as Wilshire 5000. So he looks at the big market, everything, divided by GDP. And the big market divided by GDP is higher than it's ever been. So Warren Buffett's valuation metric, highest valuation we've ever seen. PE ratios off the chart, higher than 2000, which is an interesting thing to tell us. So I remember when I was doing these conversations in 2008, and it was very dour, and I'm starting to get that feeling again. It's really negative. It is what it is. Okay. So at the same time, global executives, their optimism is waning. So they started in the first quarter of 14, 50% thought it was going to get better in the next 6 months, 9% thought it was going to get worse. By the fourth quarter, only 33 said better, 20% said worse. So better over worse drops from 41 to 12. So everyone is saying, it got a little better. It's not going to be that much better 6 months from now. So either we've eaten up all the good in their minds, or, well, that's it. Okay. Different across different categories. Manufacturing is the worst, obviously. Services, IT, construction's getting better. I mean, I drove to pick these guys up at the airport. And you drive across the bridge and you look at the city of San Francisco. It's just mind-blowing. There's just huge cranes. There's so many condos going in. So construction is huge right now. Massive. IT, Dell went private, so we lost one of those kinds of things. But when you see Michael Dell get interviewed, he said the PC's not dead. They're having upgrade cycle, upgrade cycle, upgrade cycle. Dell is now incredibly successful again. Services, also very good. That's a lot of healthcare. That's why that one's in there. Okay. And this is interesting. So there's a small sliver in everyone's portfolio not in preservation that's in frontier markets, just a small sliver. And it's interesting when you look at this, of the places where they expect it to be better, the Middle East and Africa is the place. They've got a lot to overcome. They don't have the most regulated markets. That's why they're called frontier markets. But in terms of business conditions and improving place, they have the most upside. I think that's the way to say it. They have the most upside. They have the most optimism about what's coming down the pipe. So we have a very small sliver in client portfolios that's in those kinds of things. But, across the board, you see 20, 16% think it's going to be better. These are declining as well, but there's still some positive there. No one's saying it's falling apart. So why is it we're transitioning from the US companies to European companies in our portfolios? And this is why. European companies' earnings grew on average of 15% in the third quarter compared to American companies are growing by 10%. And we've just seen that we expect US companies in the year 2015 to grow at about 7.5%. And we know that those numbers are coming down. And one of the reasons those numbers are coming down is because the dollar is getting stronger, right? Because the global environment is changing. It wasn't unexpected that this would change. Once you saw profit margins go where profit margins went, and once you saw oil go where oil, these are things that we can see, and we don't go wholesale from US to Europe. We're not selling everything and moving over there. But on the margin, we make those shifts. So that's what the world is doing. I hope you guys are doing something fun this year. Let us know what it is. If you have goals you want to reach, personal things, I've started meditating again. So when you see me, ask me, are you sitting? Are you sitting? You know, hold me accountable to that. That's my thing that I need to do more of because I'm hyper tense and stressed all the time. Thank you very much. Time for questions?